Hello, everyone, and welcome to today's incredible event, talking about the business model of venture capital. This may, in fact, be one of my favorite conversations that we're about to have, and we're so glad you're joining us. If this is your first time, welcome. If this is a repeat attendance, we're delighted to have you back to our community. As a reminder, the NASDAQ Entrepreneurial Center is an independent nonprofit with a big heart and a big mission to make sure that our entrepreneurs are taken care of each and every day because of all that you're doing for us in the world. We need you now more than ever to be building incredible companies that can change and have an impact for the benefit of all of us. Now, before we get started, I've got a couple of housekeeping things I just want to go over today. Most importantly, this is a session for you. So use that live Q&A function at the bottom of your screens. If you've got questions for Jarrod or for myself as we go through this, we want to hear from you. Pop them in. We'll get to as many as we possibly can. Another thing to know is that a lot of our programs here are all based with a pay it forward approach. As you know, we're here to make sure that we're putting forward programs that matter to you. So as we go through today, if any ideas spark where you want to go deeper, please make a note of them in that chat. We're also going to be surveying you at the end, and we want to hear your ideas for what other sessions can make a difference in the lives of you as entrepreneurs. A lot of this that we do would not be available without our incredible sponsors. So before I get started with the other line of business, I just want to take a moment to recognize and call out their contributions. Thank you to all of our sponsors for believing in this work, and most importantly, for believing in the work of our entrepreneurs. We so appreciate you, and we're so incredibly grateful that you allow us to do all that we do for free. Now, a lot of what we're talking about today starts and begins with mentorship and sponsorship and finding champions for you. So if you didn't see in that opening video, we have a big movement underway called Mentor Makers. This is an open and accessible platform that aims to empower you as entrepreneurs to find the mentors that you can tap into in really quick, easy ways to get the information that you're looking to. So if you are raising venture, if you are trying to navigate the process of finding the money that you need to build the business you're inspired to, please take advantage of that platform. And if you're joining us today on the other side and you're sitting there as an entrepreneur who's been through this road before and has time and capacity to give back, please know that our entrepreneurs need you. So we'd love to have you join into the platform and give available time and capacity in support of them as well. Again, the topic that we're talking to today on venture is one that has a lot of weightiness. So as we always do, we want to take a moment to just pause and invite all of you to share with us today how you're doing. It's been a long journey, as we know, through the last couple of years. We just want to ask you, how are you feeling? So I'm going to put this poll up. Just tell us without overthinking. Hopefully a lot of optimism, but understandable right now if you are going through a lot, especially with the holidays scarily right around the corner. So let us know how you're doing, and just know that this information we take to heart, and we try to continue to prioritize your wellness above all else as entrepreneurs in the field. So we appreciate your honesty and transparency in this. I'm going to take just a second more. We've got a lot of great participation. Thank you so much for all of you sharing today. And I'm going to share the results. Again, this journey of entrepreneurship is a lonely one. It's a hard one, but we want you to know, even in a virtual setting, you are truly not alone in how you're experiencing this. And we are here for you through all of that. So thank you for sharing. All right. Now, I told you this is going to be a good conversation. For those of you who don't know, my background actually is entrepreneur, and then I flipped to the dark side, did a short stint in investment banking before spending 11 years in venture myself. I always was faced and intrigued with this idea that venture isn't actually talked about as a business model itself. So I'm really excited to have an incredible guest with us today, Jarrod Barnes of Emerson Collective. Emerson Collective is one of the premier venture firms that is really focused, most importantly, on founder first mentality. And we're going to talk a lot about that today. And Jarrod himself is just investing in some cool companies, ranging from sports tech to future of work and all things in between. But I'm not going to butcher his background. I'm a big believer that we're just going to invite Jarrod to sort of do a quick introduction to himself. But Jarrod, it's such an honor and a treat to have you here today. Thanks so much for joining me in this conversation.
Thank you so much for having me. Good morning, good afternoon, everyone. Really excited to jump into our conversation today. Also excited to see one of our Emerson Collective founders in Jasmine Crow on the intro video there, and the amazing work she's doing at Gooder. But really excited for our conversation. Again, my name is Jarrod Barnes. I'm originally from Columbus, Ohio. I grew up in a very blue collar family, did not grow up around big tech, was not exposed to venture capital, and actually until later in my career, but always had a natural curiosity and wanted to make an impact. I knew I wanted to do something consequential, right, for this world, and didn't necessarily understand, what that would be early on, but really found some amazing, as you mentioned, mentors and sponsors in my life who really opened up my perspective to a lot of what we're going to talk about today, to shine a light on the fundamentals and certain things that are often kept in closed networks or not necessarily, shown out to the public as much. Really helped me get a great understanding of what venture capital is, how this industry works, and more importantly, how I could actually make an impact through this space as well. So that's a big part of why I'm here and excited to jump into our conversation today.
Oh, so good. So good. Okay, so let's go with that journey from your background of where you started to how you got to be a VC. Will you help us sort of fill in some of those blanks, Jarrod?
I can, and I'll be brief because I'm excited for our conversation. Very non-traditional journey into the space. As I mentioned, I'm originally from Columbus, Ohio. Grew up as an athlete. Sports were a huge part of my life. That was really my pathway to social and upward mobility growing up and coming from where I came from, right? I said, hey, I want to get really, really good at this game of football, and that's what's going to create value for myself and my family. Well, had a chance to do that at a pretty high level, played college football, briefly in the NFL, and then decided to go right into football coaching. Absolutely loved this idea of developing people, of mentorship, of training, of education, and always was fascinated with technology and how to amplify that. Very quickly went down many rabbit holes of curiosity, discovering new technology, which ultimately led me to this field of venture. Long story short, did a variety of different programs. I really came bottoms up, right? Didn't necessarily go the MBA route, really went and sought out individual, which we'll talk about today, general partners, and kind of just bootstrapped and pieced together work experiences, quite frankly, just opportunity to really put together a resume to land where I'm at today with Emerson Collective, and quite frankly, so humbled to be part of a great organization where we're able to have an impact at scale. So with that, yeah, excited to jump into it.
Amazing. Okay, so let's start with the basics.
Yeah.
It's important to get to know the players in anything, in your sports, you know that better than I. So let's talk about who are the players that are involved in venture capital, and we'll name them by type, and we'll just kind of give some real honest definitions there.
Exactly. In order to play the game, you have to know the players.
You got to know the players.
So really three major key stakeholders, right, within venture capital. What we often jump to are first the venture capitalists. Well, actually, somebody funds venture capitalists. Those individuals are called limited partners, right? Those are the funders in this entire ecosystem. Limited partners could be pension funds, they could be high net worth individuals, they could be corporations, they could even be other venture funds, right? They are the true funder of venture capital. Venture capitalists themselves are really the mediators, right? They're the ones who identify and select and choose to make investments in companies. And then you have startups, which are truly the ones who are creating value within the ecosystem. Those are really the three key stakeholders within here, right? You have the funders and limited partners, venture capitalists as those who are deciding and making the investments, and then startups who are creating value, building great companies, ultimately in the entire effort to have this economic flywheel take place.
Love it. Okay, so I'm gonna stay with you just for a second and go a little bit deeper in a couple of those categories.
Yep.
Limited partners, are they hands off? Do they get to know like the investments that are being made? Are there different types of them? Can you give me a little more granularity on the world of limited partners?
Yes, and that is a great question. I'll say, in general, they are all different, right? Some limited partners, very, very hands-on in the specific type of criteria they want to see, in the type of companies that they want to see, and the type of impact that they want to have through their capital. Other limited partners, a bit more hands-off, right? Gives a greater level of autonomy to venture capitalists and venture funds to make those investments, really simply focused on driving returns, right? Ultimately to the fund and some more back to them as well. I think at the end of the day, what we're seeing now, limited partners having a much greater hand in the venture ecosystem than I think ever before, right? Everything that's happened with COVID, everything that's happened with the social justice movement has really reset the bar in terms of accountability, in terms of metrics, and in terms of what actually success looks like for not only limited partners, but for venture capitalists, and most importantly, those who are receiving, in a sense, this funding.
Yeah, I love that. And, for those that are curious, this will be the part where you might smile a little bit, all that paperwork that VCs like to ask of you, executive summaries, PowerPoint decks. For what it's worth, LPs actually kind of do a little bit of the same with VCs. VCs typically have to put forward this thing called a PPM, which basically sort of outlays their thesis, their theory in the world, right, Jarrod? And then you kind of pitch, you go find your LPs where that resonates, and that's how you sort of bring forward the money for your fund. Is that fair?
And it's a great point because, again, understand that as a venture capitalist, you are also pitching, right?
All
Right.
the
Yeah.
time.
Startup founders are not the only ones who are pitching. Venture capitalists are pitching upstream to limited partners in order to secure that capital for their fund. They're pitching downstream to startups to ideally get the best startups to be part of their portfolio as well. And I see a comment here. Can I repeat that? Yes. Most importantly, venture capitalists are not the only ones, startup founders are not the only ones pitching. Venture capitalists are very much pitching as well.
Always be fundraising, always be closing on both sides, it feels like, huh? All right, let's flip to the other power dynamic that we talked about there, VCs. Now, just like you talked about limited partners, oh my goodness, there's a whole swath of them. VCs, they all look very, very different, I know. But could you give me a little bit of sort of general classification of the types of players inside of a VC firm that an entrepreneur might come into contact with, from an associate all the way up to a general partner or CFO type of roles?
Absolutely. So just like any other organization, standard venture funds have a lot of structure internally, depending on the size of their fund. And I know we didn't necessarily get into it, but venture funds, there's a fairly wide range of the types of funds, which we can hit on later in a second. But depending on the size of fund, you will typically have a general partner and or managing director, right? That's typically, the leader. Think of that as the CEO, COO of a fund, core decision maker, core driver. Within that, a team as well that's underneath a general partner, you'll have likely a principal, other investors, associates, and analysts, all that each have individualized roles, right? Typically, analysts are more focused on market research, more focused on customer discovery, interviewing different customers, really focused more on analysis. Associates, senior associates, and principals are more so than actually focused on diligence, putting together investment memos, ideally to get to an investment decision or a investment recommendation for that general partner, then to make ultimately the decision as well. So if you see kind of the decision tree, internal org structure of a venture fund, and if you're communicating with investors or venture capitalists, just having an understanding of where they sit in the organization and ultimately where decisions and how decisions are being made. Right. I think, on paper, it's easy to make an assumption. I think it's a great question to ask if you're fundraising. Can you walk me through your decision-making process, right, of how you make decisions as a fund, simply because everyone is different. There's also right now what we're seeing, the rise of what's called solo capitalists or individual general partners who raise a fund and deploy capital as the sole decision maker. And so there's a lot of different ways, again, that we can get into minutely, but overall, that's typically how the structure plays out.
I love that. So don't give up if you get meeting with the associate to start with. They are critical people. In fact, can't even tell you how many deals got started with being nice to the executive assistants or the office managers to get into the door. Everyone matters, as we all know, and I have no problem on our community knowing that always to the core. But let's talk a little bit about how they're rewarded. So here they sit as intermediaries, always raising money from LPs, deploying it to the entrepreneurs. How does their comp actually work, Jarrod, at the end of the day?
It's a great question. It's interesting. It's a little bit different than what you would see on a standard salary-based job. I think to give it a little bit of context, right? A venture capital fund, if say, hey, let's go raise a fund right now. If we were to do that, we would have to really think about, okay, what size of fund am I looking at raising, and what would that fund life cycle be? Typically, the general framework is you raise the fund to have a 10-year life cycle. The first, 1 to 3 years, that is when you are actively deploying capital, you're sourcing companies, and really looking for great investments. Typically years 4 through 10, that's where you're focused more on management, building, helping those companies scale, and ideally getting to what's called a liquidity event, which would be some type of merger acquisition, an IPO, ultimately the sale of a company, right? And so within that, knowing that, okay, if this is a 10-year life cycle, we raise a fund to do that, typically you'll hear when it comes to compensation, this concept of 2 and 20. What that really means is venture capitalists take a 2% management fee on that fund. That is gone every year. So that's an annual 2% management fee. And that 20 is a 20% carry or a profit on the investment, right? Once a liquidity event happens there, right? And of course, we can get into more minutes on types of stock, who gets paid first, and kind of the downstream waterfall there. But that is really generally the structure. And so knowing the incentive then for a venture capitalist is really important as a founder. Why? Because it gives you in a sense to how they're evaluated and how they're rewarded. Very similar to how founders and entrepreneurs are rewarded as well.
Oh, that is so good. There's so much goodness in there. So I'm going to just slow it down and double down on the emphasis.
Yes.
Vintage years, as sometimes funds are looked at, right? When did this venture firm raise their fund can be an indication that entrepreneurs want to pay attention to, because it may help them understand where that venture firm is in their life cycle of investing activity. Is that fair?
Absolutely. And so if I'm an entrepreneur and I'm preparing to speak with a VC, right, in my initial research on this, venture fund that I'm speaking with, I would encourage you to look at, to see when their recent fund announcement was and see what fund they're actually on, right? As we talked about, right, you can raise a fund with a 10-year life cycle, but that doesn't mean you have to wait 10 years to raise another fund, a fund 2 or a fund 3 or 4, whatever it may be. And so it'll give you an idea. You can ask the question to a venture capitalist, what fund are you investing out of? Well, they'll say, oh, we're investing, out of fund 2. And that gives you a sense to the point on vintage year is the first year that they're really deploying capital, right? And you get a sense, okay, this fund is actively deploying. They have the ability to really back me, to potentially even be a lead investor for me based on the amount of capital I'm raising. Well, if this is not a vintage year, if they may have deployed a lot of that capital already, they might just be a participatory check, or it may not necessarily have the capital right now. And so really important to go into a meeting with the potential investor as informed as you can be. Of course, you're not going to know everything, and that's the beauty of asking questions, but really, really important to understand the mechanics there. And again, we have some resources we'll follow up with that are a bit more minute, but great point there.
Yeah, Jerry, you gave us also just so many good tips, even in those comments at the end. Realize that the investment of time that you're making when you pitch to maybe anywhere from 20 minutes to an hour, hopefully you're going to be finding yourself more on the hour spectrum. So think about what is the ask that you can make of the investor above and beyond just asking for money. Like, are there connections? Is there knowledge that you're trying to seek out from them? And really being okay with being curious. The other part of the ABC that's important in this process, right? Always be curious and always be closing. So for a lot of our community, this is the first time, or maybe it's been a long time since they were out fundraising. Walk us through some of the really important tips and tricks that matter when you think, is venture right for me? Like, what is the VC thinking behind the table when they're kind of meeting with an entrepreneur to go, is this deal even venture backable? What does that mean?
Yeah, that is somewhat of an ambiguous answer. I wish we had a more universal definition. We certainly would be, I think, in a better place. I think we're getting closer, though. We're getting closer. I think, when it comes to understanding what is truly a venture backable startup, and it's a buzzword, right? I think the biggest thing when it comes down to that is thinking in terms of scale. Right. Anytime a venture capitalist is looking at a company, they're looking at in terms of, is this concept, is this business scalable? how quickly could this get to market? What is the speed to market here? How defensible could this product be, or different than other existing players in the space? And then, one other thing that I think, we've spent a lot of time talking about it at Emerson, and something I think is a bit more black box, is thinking about quality of revenue. And when we say quality of revenue, right, it's not always, if I'm an entrepreneur and I generate $1 million, right, through my service-based business, right, and I'm a consultant and I've busted my butt and I've generated $1 million. That is an incredible achievement. Now, is that model venture backable? May or may not be, right? And so what we look at in terms of quality of revenue is how recurring is your revenue? Is there opportunities for it to really scale and operate, in a sense, automated or autonomously, and able to have a model that if capital were infused, there's a clear pathway to how this engine could be really, really going at a pretty high speed and high pace as well. And so lastly, we really look at what's the size of the vision here as well.
And that vision alignment matters so much, right? It's where you can feel like you're in lockstep with your funders, and where you don't want to be is when you feel like you're both seeing a different vision, and it's just tough in the board meetings and it's tough in the uphill slog. And that matters so much, as we know. We mentioned early on the importance of being able to find a little bit of time and space if you're going down fundraising. Oh my gosh, it's like an all-consuming thing, and it feels like it's never ending, and it's such an uphill slog. From your experience, from what you've seen and managing and mitigating expectations, what do you think entrepreneurs should really be thinking of for like the investment of time that it takes to do fundraising in their first round? So obviously it's different later stages, and we can talk about that if you're inclined, but I definitely don't want to gloss over the investment of time and energy in that first fundraising event.
No, and to your point, it is a big lift. It's arguably, one of the more challenging aspects that you may ever do in running a business is fundraising, right? And I think it can be, again, just personally as a former founder myself, it can be really discouraging if you see funding announcements of companies. It's like, oh man, it seems like this money is just coming so easily to them, right? I think first and foremost, really identifying for yourself in a fundraising journey overall. I think the key is just being honest with yourself and truly understanding your business to the T, right? And I think that's only going to help you position yourself for a fundraise, and ultimately, the time frame and, in a sense, effort that you want to dedicate to that, right? Ideally, a general fundraise could take anywhere from 6 to 8 weeks at the early stage. That's going from first meeting of, hey, Jarrod, great to meet you. This is the first time me sharing my company, to us wiring the money, right? And then thinking about portfolio support. And so understanding that time frame, I think it's really important to understand as well about momentum. If there's one thing I have learned, it's that fundraising is often more so about momentum and being able to effectively communicate that than it is actually about where your business is at today, right? So there's certainly a strong element of sales. There's certainly a strong element of effective communication, right, within fundraising. And so really identifying and honing in, okay, if we're going to go for this fundraising, we're going to dedicate and take time away as a co-founder or CEO of 6 to 8 weeks away from what I would regularly be doing as a CEO. One, what infrastructure needs to be in place for my company to still go? And then two, what is it that we need to really be thoughtful about as we enter into this space, right? And how can we best communicate momentum, the magnitude of our vision, and in a sense, what makes us the right team to really, really do this? That at a very, very high level, without getting sector specific, is at the early stage, a core focus I would think about in fundraising. Of course, as you get downstream, you have much more data and economics to point to justify, that execution. But in the early days, it's really being thoughtful about those, I think, key points there.
So good. So we're going to stay on that sales momentum theme.
Yeah.
Drill down just a little bit, because one of the things that often happens, no investor is very good about saying the words no right out the gate. A lot of the time they're like, this is really interesting, keep me posted. And then there's this art of like syndication where you're supposed to hopefully find a lead and then all of the other followers will follow. Help us think through like process-wise, again, putting on our sales hats for a moment, what is a good communications plan that you've seen actually drive results? How often is too often to be keeping everybody posted on results? And how to find this like unicorn thing called a lead, because that is often like one of the hardest struggles out there.
Yeah. And let's get tactical here. So I think some of the best insight and advice I've gotten is an individual who I have the privilege to work for in Fern Mandelbaum at Emerson Collective. And one of the things I've found in entrepreneurs who really are able to close the gap in time that it takes to fundraise around is actually being very targeted in the investors that they're approaching. So you may have kind of your dream investor, a tier one, like, oh man, if this individual, if this fund could, invest in my company, like this would be awesome, right? Typically what we would think about from a strategic standpoint, think about talking to tier one or those dream investors, maybe second or third in your process, right? Starting with your tier two investors. So you would say like, hey, we'd love to have them participate, starting there. And if you are able to get a yes or move in that process with them, that can help build momentum, right? And it also allows you to really craft your pitch before going to a tier one or your dream investor, right? So you're able to really hone in and see what resonates, what doesn't before going to a tier one. So you're starting with these tier twos, you're able to get momentum, you're able to get, hey, yes, we got now we have X amount of capital committed to the round, right? We have, Y amount of firms that are in diligence with us. And, now we're really just looking for a lead. That is much more compelling of a communication of momentum versus, we just started, we're talking to a bunch of people and do you want to invest? Right. And of course, that's not how it comes out, but being very targeted about the strategy that you have in order to build that momentum and drive what you're trying to do, you're driving urgency. You're telling me, hey, Jarrod, if you want to invest in this company, I'm going to need you to make a decision, right? Or you won't be able to invest. And I think that is right now, if there's one thing I hope the audience takes away from this is that you as the founder, you are in control, right? You are truly in control, right? I think the extent in which you have the ability to sway investors, that can vary based on what you're building, but truly the power dynamic is in your hands as the founder, right? And so being very clear and very direct in where you're at and what you're looking for in what it is you're trying to syndicate or build when it comes to your fundraise, I think is only going to help be more convincing and really get people to move, right? Because that, again, gives me a direct incentive now to have some urgency in everything that I'm doing.
So appreciate that level of confidence build. And again, that very important reminder that at the end of the day, they have a vested interest in being able to make you an investment. So you're going to return 20% profits back to them, which is the name of the game. All right, I'm going to switch gears slightly. The other area that is so fraught with nerves, and rightfully so, is whenever founders who are thinking about their company as their babies, rightfully so, start wondering how much to value it at, and the worry that the number and the ownership is just this weird art and science process that is completely convoluted. And it partly is, right, to be fair. So let's help our founders think through valuation, what it means, what matters, maybe what even doesn't matter, and to be as transparent as we can in just the way that the math all comes together at the end of the day.
Yeah. I think this is the one area for me in my journey as a founder, and even my journey, beginning in venture capital, was always intimidated by, because this is a bit more technical. And I think this is where it pays to really understand VC math and really understand what's going on kind of behind the scenes here when it comes to valuation and when it comes to specifically understanding where you're at on that journey, right? So a couple of things to the exact question here. I think first and foremost, evaluation is simply just, what an investor believes to be a fair, market price of the total value of your company, right? What is it worth in a sense today? If I were to give you this term sheet or agreement of this valuation, right, that we have common ground there. right? And a couple of ways that it's calculated, there's what's called a discounted cash flow. That's a bit more in investment banking. There's what's called fair market value that really looks at a number of components, around your business, around your overall pipeline, revenue, so on and so forth. And then there's what's called the VC method, which is a bit of a combination of both and looking at comparable companies in an industry that you're building who are now either publicly traded or have had a merger and acquisition, right? So these are all the data points, right, that we talked about earlier that, associates, analysts are really going behind the scenes to tactically look at, right, and get to a point where what's called valuation underwriting, or getting to a clear number that, a venture capital firm would believe in, that saying, hey, you're raising $2 million. We believe, a fair valuation for this company. We would lead this round at a, $17 million post-money valuation, right? And we can get into what pre-money and post-money means in a second, but, I think that is, what's going on behind the scenes as we think about it. Why is that important? Because that also has a direct correlation and impact to ownership, right? And that is, if there's a lot of things you can change about your business and iterate on. The ownership and equity stake in pool, that one is very, very hard to change once it's set. And so this is one where I would encourage all founders to be really thoughtful, spend time on and thinking through and thinking about in ownership. If a fund has an ownership target, and how much ownership are they looking to take? How much ownership? And I know we're sharing a lot here, so this is like a lot to unpack, and I don't want to do too much, but I think we'll stop there and keep going before I get on this horse.
No, but it's so good, right? Because if you're, again, there's only so many hours in the day. That's another math number that we're not going to change. And so if our entrepreneurs are going to go pitch to 20 funds, they got to start, you don't want to be pitching to people where you're like, my company doesn't need to raise $150 million. So like this type of portfolio, which, Jarrod gave a fabulous idea. Go to the portfolio, go to the comps that you can see. What has their past behavior been like? Do they lead? Do they follow? How much is the investment size that they're investing in? We'll give you an indication of like, this may be like larger than I need, or this may be smaller than I need. What you need is what should drive the priorities as to who you're pitching and where you're pitching and those types of things. But you offered a very important behind the scenes look on pre-money, post-money. I'm going to throw in a couple of other terms that entrepreneurs often get like, are you kidding me? What the heck does that mean? Option pool and refreshes. Without getting too scientific and too deficient in there, can you give us a little bit of like, why does that matter from the founder's perspective? Pre-money, post-money, and then definitely option pool and refresh.
Yeah. And I'm actually going to start with the option pool, ironically enough, simply because this is the one, as the founder, I would say you have the greatest influence to control, and ultimately has the greatest impact, not the greatest, but a large impact on your company in the future. So for context, right, we talked about pre-money and post-money. Pre-money is simply, the valuation, that number, right, that we discussed, how it's calculated, right, before any capital is infused in a round. Right. So if we use a $10 million, pre-money valuation, you're raising a $5 million round, for lack of a better term. That pre-money is 10 million, right? With that capital infused, you're now at a $15 million post-money valuation. Post is simply the pre-money plus the amount of capital that is invested, right? And the option pool then is typically determined either A, by a lead investor, or B, by an entrepreneur. By the founding team, really designed to set aside additional equity, right, within your cap table, within the total pool of equity that's available for future hires, right? This could be used for executives. This could be used in a variety of ways, but it's really designed to actually protect the founder and ultimately make this the most successful team as possible by attracting top tier talent. And so knowing all of that and being cognizant of all of that, in a sense, equity that is being created and kind of being changed here a little bit, it's very important to understand dilution. And A, how much dilution should I expect? B, how much is too much dilution, right? I didn't have a chance to pull the exact article as well. I'll have to share it, but you look at a couple examples here of companies. I mean, you look at MailChimp, you look at Atlassian, companies that either A, didn't raise a ton of capital, or B, kept a lot of ownership throughout their fundraising journey were able to do it really well. Other companies, founders got significantly diluted. And so why that's important is you can work really hard and get to an acquisition or some form of liquidity event, but not have a lot of, in a sense, equity stake in the company left. And so you always want to protect yourself, being really smart about that. Typically in any major funding round, you can expect about 20% dilution. And so factoring that in as you understand valuation, right? The higher the valuation, the more equity you're going to be able to have there. And so understanding that, also understanding what it's going to take to hit that valuation to trigger for your next round. So there's a lot, again, we can unpack there further, but at a very high macro level, couple keys to really understand and really focus on.
So good. I'm going to take a question that came in because we're here right now, so sometimes it's good to stay there. We're talking mainly about equity, but it's like so many different flavors of ice cream that you can raise money against. So let's talk about safe notes and some of the other options that entrepreneurs can also think about when it comes to it. And does that affect things like valuation?
Yes, great question. And, safe notes, I think, are an awesome, in a sense, tool to leverage when you're thinking about raising capital, specifically at the pre-seed or even seed stage, right? They're a phenomenal, and I'm blanking on the exact finance terminology right now. I don't know why, but great tool to leverage, right? So they were created by Y Combinator. Simply what a safe is a standard agreement of future equity. And so what that does, it really allows you, in a sense, to protect yourself if you're not necessarily ready for a priced round or getting to that exact valuation just yet, right? You're like, hey, this is still really early. We don't know how big this could be. And so let's just raise what's on a safe note in order to really protect ourselves. Typically with that safe note, there's going to be what's called a valuation cap, meaning that there is some number associated with that. Call that you're raising $1 million on a $5 million valuation cap. What that means is, once you do hit a $5 million or above valuation, that safe is going to convert into equity, right? Without pulling up an Excel spreadsheet right now and getting into the minute of a capitalization table, that's really what it is. It allows investors to move with speed. It allows you to receive money with speed as well. Couple considerations to think about is, without getting into it too deeply, is are there going to be discounts on that? Meaning, how does that affect you downstream? And also two, right, if you think about raising multiple, small rounds on safes or what's called convertible notes, there are going to be a lot of conversions as well. And so just understanding, again, the math associated with this. By no means do you need a full MBA in all of this. A lot of this is publicly available information. But I think the key is really understanding conversions, when it converts, and specifically, understanding dilution as well when it comes with that.
Love that. So good. Okay, so we know that there is competition in our domain, meaning that we might be an entrepreneur working in a space that has 5 known competitors and 10 that could potentially enter there. But I think what sometimes can get lost in translation is that for seed funds or early stage funds, you're also kind of competing in a deal flow environment against a number of bigger deals. And by number of bigger deals, I just literally mean the number of people that are trying to raise money. Can you sort of help walk through deal flow, broadly speaking, inside of a venture firm? How many deals are they looking at? How many deals might be due? And again, I know high variance there, but generalities would be great to even discuss at this point.
Yeah. And I think, first and foremost, so much credit goes to entrepreneurs who are building, right? It's an incredible time to be building right now. That said, that's also an influx of inbound and outbound companies that are coming into a venture fund. Typically, for us at Emerson Collective, we're right around, 1,000 to 1,200 companies that we see every single year annually, right? So you break that down, that's, roughly 100 to 110 companies a month. And so that is a lot of information to assess, right? Of that 1,000 to 1,200, I would say about half of those companies, we get a chance to actually go meet with, whether that's a quick 20 minutes or could even be longer. So call that, 500. Of that 500, we would probably take 100 to then really think about, hey, can we spend some more time here? Let's do some real diligence. Let's do some market analysis. Of that, about 40 make it to what's called a partner meeting or partner review, meaning that goes to a general partner or decision maker. From there, I would say about 15 to 20 would be actually, moving forward in an investment. So if you break that down using, 1,000, that's about 1 to 2.5, 3% of companies make it all the way through a funnel of an institutional venture fund, right? There's a lot of pathways to funding, which we'll talk about a little bit later. Simply from an institutional venture fund, again, one that has a agreement with a limited partner, that's typically how the funnel goes, to give you context on just how many companies a venture capitalist would see.
Oh, so good. So that inflection point that you just talked about, the general partner meeting, kind of like the right before we're so close, maybe we're going to get this money eventually. Who's pitching you in that way? And like, how do you make sure that like you've got a good champion that's rooting for you over other deals at that point in time?
It's a great point. This is such a minute point of fundraising. And typically, it's unique where ideally as an entrepreneur, you certainly want to talk to a general partner or a partner. Absolutely. It may not be your first meeting. You may be speaking with an associate or an analyst, right? Not to say that person isn't worth your time at all. I would say they very well are. They're certainly going to be the internal champion to remind that general partner, right? We just talked about, you see 1,000 companies a year. How do you differentiate? Well, you have internal champions, right? You have people who are pounding the table saying, hey, we gotta move on this company. We gotta invest here. And so the more touch points within a firm or within a fund you can have, I say the better. And so treating, each individual, right, the same, and really making sure in your communication, if you're in communication with an analyst associate, maybe have a quick, whether that's a weekly or bi-weekly, every other week, kind of check in, email, hey, is there any additional information we can provide? Or to sharing updates and sharing that momentum, absolutely helpful in that process, right? And then two, at that partner meeting, understanding that anyone else who's on that line has been advocating for you to get to that point, right? Ideally, typically within a fund.
Yeah, I love that. Jarrod, this has been so helpful. I've got a couple more questions, and then everybody hang in there. We're going to flip over to your great questions that have been coming in. Now's a good time. If you still have one that you haven't popped in there, please go ahead and add it into the mix. First one is, obviously we've talked about the process, 6 to 8 weeks. There's a lot of conversations that are probably happening there. Yep. Maybe what we haven't done a fair job of yet is talking about maybe some of the red flags that might be emerging during this process. Can you help us think from the entrepreneur's perspective what those red flags or yellow flags might be as they're entering into these different layers of conversations in the venture fund?
Yeah, and you're specifically talking about red flags on the
why it's not going to go forward. Yeah, exactly. Where are things like getting lost in translation, or maybe not going in the direction that the entrepreneur is hoping they will?
Yep. So couple things I think to consider and why things may not be moving forward. First and foremost, it may just be fit, right? So that I think it starts with really identifying the investor that you're talking to, and is there just an underlying fit there? If I'm building an education company, am I talking to an ed tech or an education investor? Or am I talking to a general consumer investor who may not fully understand the business, right? So there's maybe just high level fit and understanding in what's called a thesis in a specific market. Number two, it actually may be about your company, right? It may be the sector or market that you're building in. There may be some questions, some confusion there. Is this a big enough market, right? Typically, institutional investors want to see $1 billion plus market that you're building in. And that's, again, TAM, maybe not your SAM or SOM, but really understanding the total market size. This may be, is this a small market? It may also be competitors, right? And of course, there's competitors directly or indirectly in every sector, but really being clear on how you position yourself is really, really important because of competitors in the space. Because again, as investors, the challenge of being an investor is actually not pattern matching, but having pattern recognition. Because as an investor, again, we see 1,000 companies a year, right? And so what you do, you see these repeatable business models, you see what works, what doesn't, and it can be very easy to say, oh, I saw this and it didn't work, therefore this company may not work. And so knowing that that is the inherent flaw or bias that happens as an investor, being able to clearly differentiate yourself and say why in a pitch, I think is also very helpful. And if it's not overly clear, that could become a red flag. Other actual red flags, when you think about your cap table, when you think about how, in a sense, you're structured internally, right? If you've given up a lot of equity as a founder, that could be somewhat of a red flag as well for an investor. The price of your round, right? There could be a lot of factors here as well. One subtlety that I actually really look at how teams communicate with each other, right? How co-founders talk to each other, right? How they treat each other internally, right? How a customer would speak of you, right? How reviews may be public if you're a consumer-facing company or an enterprise company, right? All of these are points of diligence, points of reference that we do as an investor.
Yeah, I love that. Not all entrepreneurs need to raise venture. We all know that. Like, you can have, just like you perfectly started out the conversation with, such a good, successful, great company never raises a dime. But they might need to raise other types of capital. So before we shift gears, let's talk about what alternative methods of fundraising could or should be on the minds of people thinking about venture or not thinking about venture.
And it's such a great point, because venture, as attractive and as exciting as it is, it doesn't necessarily mean it's the only source of capital. And I just saw a comment come in about crowdfunding. I think it's a great place, and maybe we can start there and build. Equity crowdfunding, a great way to engage your audience, to help build up, whether that's through Republic, whether that's through Seed Invest, a number of these equity crowdfunding platforms, right? You have the opportunity to find strategic angel investors or individuals who can amplify and infuse capital into your company. You have venture accelerators, right? That give, they may or may not take equity, but they also give capital and, quite frankly, a suite of other offerings. And then you have, in a sense, grant funding as well. I don't think there's anything wrong. I've seen great companies be built off of grant funding. It's one of the most undervalued aspects within the ecosystem as well. And then, pitch competitions, whatever it may be that you seek out. But I think at the end of the day, right, anytime you're thinking about raising capital, I encourage you to raise it for a reason, and a very precise and direct reason. And the best entrepreneurs I've seen say, we're raising X amount of capital to achieve Y by Z date. And having that as a framework, and maybe as a theory, can be a great way to think about, is capital is this the right time to raise capital? Do we have everything that we need to move forward?
That is so good. X by Y by Z. It's so good. And yeah, I'll just double down on grant funding and also revenue, like using your customer upfront revenue. If you can do that, that's just gold. Anything non-dilutive is always gold, right? If you can push out, if you don't need to raise capital, and also, we didn't touch on it, but make sure that it's value-based. So again, it shouldn't just be the dollars coming in. Hopefully you're also super excited by the portfolio, the knowledge, the general partner that you're working with, the additional mentorship that you're getting by being part of that family too. All right, I'm launching a poll really quickly because we're going to take a moment to shift gears. This one, though, just while I launch it, what's keeping you up at night? I need you to know, for all of you community here, what you tell us in these polls is actually what we build as far as programs. So if you need more finance, sales, marketing, scale, pivot team, just hanging in there and surviving, whatever it is that you need, our incredible program team at the center is going to go around, source great experts like Jarrod, put them forward, and you'll see this in December and January. So you right now are making a choice with us as to what programs we're going to be building for you in the next 8 weeks. We're very agile in that way. So thank you for answering it. I'm going to keep it live while we switch over gears. Now, the first one is one that we had actually talked about. And we're like, oh, we got to get to it, but we may not get to it. So I'm glad it was raised. First time founders, and especially our entrepreneurs of color, are always hearing, oh, there's never been more money. It's never easier to raise money. But that's actually not true when we look at our first time founders, and we also look at our entrepreneurs of color. They're often told to go get warm intros. And we all know that. Yes, if you can do that, that's great. But what other tactical advice, Jarrod, might you have for people that are on this journey for the first time, and especially our entrepreneurs of color that don't have a past performance that they can point to that would allow monies to just be flowing in? How should they think about building up, a network of sponsorship and support that can really make this happen?
This is the million dollar question right now. And, I'll be honest, I'm humbled to even, respond to this question. This is in a sense, just my perspective and opinion. So please take it for what it is. I think there's an opportunity here, right? If you haven't necessarily, say you don't necessarily have access, right? And again, that's a huge uphill battle here. Think about how you might be able to build that access in a sense through people who are not investors. Right? Can you find ways to get extreme customer love and love from your customers, so much so that could be your pathway to investors, right? Could you find ways to in a sense, reach out to operators, right? Or individual folks. I've had so many, people who are the VP of engineering at a sizable company say, hey, have you seen this small startup? Look for champions. Right? I would remove almost the term investor and identify who are the champions in my life and how could I tap into the access, right, that they could provide, right? Really identifying those champions, building, in a sense, relationships with those champions, who they could be. But at the end of the day, I think the other aspect too, right? Say you haven't had an exit under your belt, or this is truly your first company, right? And you don't necessarily, have this huge track record of other aspects that you can point to. Really think about and quantify the execution that you've had to date as well. I think each and every one of us brings something to the table, and really thinking about how can you quantify the execution you've had to date, why you're the right person to do this. And I think the other aspect in space that you can invest time into is having genuine market awareness and seeing how you can establish yourself as a thought leader in your market. Right. So you're building, and I keep saying education, I'll use a different example. You're building a fintech company, right? How can you establish yourself as someone who really understands, neobanks for Gen Z, right? The one thing that is democratized is the ability to produce content. And so really thinking about, okay, right, I don't have the network. How can I create this? How can I create these champions? Really establishing yourself as a thought leader and spending time how you might be able to do that. And again, that's not a fit for everyone. I would encourage you to lean into what's most authentic for you, but that is another powerful way. Why? Because a big part of my job, I'm looking for thought leaders. I scour the internet like 8 pages deep on Google, finding who are the next, in a sense, thought leaders in a certain space. And what is it they're building? What is it that they're thinking that I may not see? So I think tactically thinking about who are the champions in my life, how can I leverage their access, right, as well, right? How can I build somewhat of a community of champions, specifically through thought leadership, or if it's hosting events, or if it whatever comes most authentic to you, I think are all great ways to establish yourself within the space.
Oh, so good. I'll also say, I'd be curious if this is true for you. One of the greatest hacks that happened when I was a band is if I got a call from a portfolio company of ours, it's like, oh man, I just met the most amazing entrepreneur. You got to meet them. Like 9 times out of 10, I was way more likely to do that with a portfolio company's recommendation, even than I was like, honestly, reading something interesting on like a TechCrunch kind of a thing. So I don't know if that works for you too, if you find like strength in, getting to know portfolio companies of teams that have worked in unlocking doors.
Could not agree more. Such a valuable relationship to have, not only to get insight on what that investor,
what the investor was like. Are we good? Are we bad?
Exactly. That's a very important piece, but also too, as a viable pathway to meet folks within that organization. Could not agree more.
Well, diligence is a two-way street. It always works that way. Speaking of diligence and two-way streets, great question in on like, well, do these VCs that are getting paid rather well also have skin in the game? Can you talk a little bit about whether or not there's sort of a pay-to-play expectation with venture capitalists and their investment that goes on behind the scenes too?
Yes, and again, it depends on the type of fund and the type and how that fund is structured. right? There's a couple ways to think about it in kind of this term of pay to play from an institutional standpoint. Paying to play could mean that this, investment fund invests a small amount of capital in an early round to then have a chance to even participating in a later round. That also could mean angel investing at an early stage to then have a chance to invest at an institutional stage as well. And so there is a high amount of incentive to do that. Again, it depends on the fund, how the fund is structured, and what type of investor you would target. But I think at the end of the day, right, there's investors, the best investors will operate with optimizing for the founder. Right. Again, it can be, a tough industry, but again, I firmly believe the best investors will optimize for most success for the founder, because if that founder is most successful, that means a win for the investor as well. So that's how I would think about it.
That's great. That's so good. A lot of people asking about like sources to identify investors in the first place. Do you have a few favorite ones that you often suggest for people to just get kind of a ground level?
Yes. Yes. So if you're looking for a general broad database, NFX and their Signal database is a great one just to really kind of scan by sector, by stage, just to see. I think another easy way as well, a platform called Crunchbase that's much more focused on companies, looking at companies that you admire and then going back through and seeing who invested in those companies. And then if you click on an individual profile, you actually may be able to find the partner who made the investment as well. And so it's kind of multi-layer, right? Finding these databases to actually find a fund in general that you may admire or want to partner with, but then taking it a layer deeper and seeing who at that fund might be the right person to engage with.
Oh, good. I want to stay there just for 1 second, because this often comes up as an uncertainty. If a fund has made an investment in a similar but not direct competitor, does that mean that they would be a potential fit or wouldn't be a potential fit for me to go after?
It's a great question. I think that is, again, as a founder, having kind of a prepared list of questions going to an investor is really important. I think that's one of them. Asking, how do you handle portfolio conflict, right, is kind of the term there. So say we invest in, all these fintech, again, a neobank company, right? And so if we see another similar company, we would likely avoid that just based on how we're structured, and that we don't want to create any conflict within our portfolio potentially. Other investors may have a different thesis in saying, hey, that we want to invest in all, neobanks, right? I think it's really important to understand the specific thesis of how a fund operates and why they're choosing to do that. Because at the end of the day, if they do choose to invest in kind of all companies that are building in a certain space, that may determine how much help or hands-on attention, right, you would get as well. And so being cognizant of that, understanding exactly what it means to really partner with the fund.
Jarrod, I'm bummed. This is like the end of our time. I don't know how like an hour has gone by so quickly. I told you it was going to be one of my favorite conversations. This has been such an honor, really. Thank you so much for the incredible insights, the wisdom, the knowledge sharing, your graciousness and your kindness, and really responding so transparently to what is a hard field to get to know on a good day. So thanks for making it easier on this journey for us.
Absolutely. And thank you for like all these great questions. I've seen a ton of great comments. I think somebody said in there, neobank is the word of the day. I appreciate the feedback. It's top of mind, but no, genuinely appreciate this. Really always happy to continue the conversation as well. So many great questions.
We're going to hold you to that. We're going to stay in touch without doubt. And hopefully we'll be able to host Jarrod back again. It's been such a treat. Everyone, thank you so much. Now I've got an ask of you. It's going to be coming. We get better by being smarter. And the only way we can get smarter is if you tell us what we can do to improve the outcomes for you. So please take a moment, fill out that survey that's going to be hitting in the chat. Sign up for Mentor Makers. We've got some incredible programs coming up, again, based on the ask that our community had for us a few weeks back. How do you build an advisory board? Speaking of champions for good, they're an incredible source of good. We've got an expert coming in to tell you how to do that. We've got wellness for our founders. Again, knowing how much stress and pressure is on you each and every day. We've got the incredible Malika Chopra coming in to host a session with us in just a week and a bit, right after Thanksgiving Day. So we'll all be there together, I hope. And then we've got ESG for our entrepreneurs coming up? We know now more than ever, you build companies with greatness and inspiration, and you want to hold that into your culture from the earliest days. So we're going to have incredible experts tell us how to do that from the get-go, so we don't have to repipe anything later on down the road. Again, thank you so much for your time, for our sponsors, for your honesty and incredible energy today. It's been a pleasure, and we will see you all again very soon. Thanks, Jarrod.